Welcome back. Pleased to be with you once again. John Riga, the Financial Services Editor, for those didn't get to see our earlier panel. So back with you to talk about insurance. And before anyone maybe thinks this is the time to tune out, it's not for you. Let me assure you that the topics we'll discuss on this panel go to the heart of Europe's recovery from the coronavirus and its green transition. And if that doesn't get your attention, we're talking about 8 trillion euros worth of money invested in the sector. So please stick with us for that. Before we get into the discussion, I want to introduce a poll for the audience. Please do participate, and we're going to see the outcome of this at the end. Our question has to do with whether there should be green incentives or brown penalties for insurance companies. So we have a few different options. It could be, you could go green only, it could be a mix of green and brown, or maybe brown only, or maybe do nothing and just leave it to the risk management in the industry itself. So have a look at that poll, fill it out. We'll see what you have to say before the end of this session. Meanwhile, while you're in the app looking at the poll, please put your questions to us. That's in the swap card app. Just to the, I believe it's to the right of the screen for this panel, you'll see the area to put in your questions. So, meanwhile, I have a few questions for our guests. We have the benefit of hearing from Luis Garicano, European Parliament member in the Renew Europe group from Spain, member of the Economic Committee, quite active on the financial files that I cover. Thanks very much for joining us.
Thank you, my pleasure.
And also we have Olav Jones from Insurance Europe, a longtime expert on these matters. And thanks to you as well, Olav, for joining us.
Thank you.
So, Mr. Garicano, we'll turn to you first. I'd just like to ask what you think should be the objective in Europe as it considers its review this year of the Solvency II legislation for insurance companies.
Thank you. Well, thanks for having me here. It's my pleasure to be able to chat about this review, which we're expecting for the spring of 21. We don't believe that, the review is mandated by the current directive, but we don't believe that the system needs massive adjustments. The system today works pretty well. So I think what Iopa said, we need evolution, not revolution, is probably what we believe as well. Obviously, we do need to change the policies as we update it to the union's current priority, but that's not just the main objective of reform. I mean, we were talking, you were starting talking about green investments. Should there be a preferential treatment of green investments? I don't believe that belongs in pillar one. I mean, it's not a question of risk. I mean, that the risk management should take care of whether an investment is adequate and it carries enough risk or not enough risk. And I don't think that assessment needs to be driven by a desire to drive the policy green. The main job of the pillar one is to ensure that we have the assets to cover our liabilities, and insurance companies' liabilities right now are particularly concerning because we have a very volatile environment, because we are facing a pandemic, etc. So let's make sure that the main thrust of the regulation in pillar one keeps being that we have enough money to cover those, enough assets to cover those liabilities. And then, of course, in pillar two, which sets out risk management and governance and supervisory requirements, etc. Yes, we do want to think about it. And I'm not saying that the green and brown assets, to put it in the terms you were asking in your poll, don't have different risk profiles. Yes, they do. And as we advance in our efforts to fight global warming, green assets will be more and more favored. But insurance companies the risk aspects should be really concerned with risk.
Okay, so first statement there, and you're not alone, by the way, Mr. Garicano. We've already got 11 votes on this poll, so thanks everybody for participating already, and keep it going. Olav, any response to what you've heard so far?
Yeah, I think I would agree with a lot of that. I think the really focus of this review needs to be about addressing the concerns that have been around for some time over Solvency II's treatment of long-term investments, because I think there's always been a need for insurers to play their role. And by the way, I think that the total amount of assets we have is over 10 trillion, in fact, so even higher than you mentioned. And so we play a major role for our customers in terms of the returns they can get, but also in terms of the role we play investing in the economy. And given the COVID situation, given the need for recovery from that, and the need for investing in a sustainable transformation for Europe over the coming years into a zero carbon or carbon neutral society, insurers more than ever need to play that role. So I think one key element of the review needs to be on addressing the existing and concerns and flaws in how Solvency II measures long-term business and long-term investment. I think another key element of the review needs to be about the burden of Solvency II on companies, and small companies, but even larger companies, because it is a very sophisticated regime. The industry has supported Solvency II from the start as a risk-based regime. But can you still hear me?
I can on my end, so
okay.
plow on.
The industry supported the regime, but it is a very large regime with over 3,500 pages. So part of the focus needs to be on making sure that proportionality really works as it was intended, and there is a appropriate level of reporting. I think the third element I would raise is maybe what not to do. I think as was mentioned, the regime is working pretty well. The regime was not brought in because of concerns about solvency or customer protection. It was brought in to ensure a harmonized approach, an efficient industry, and a strong industry going forward, and of course, customer protection for all European citizens. But I think that there are many areas that do work very well, and so we need to keep this regime focused on the areas that really need improvement, and not to extend to other areas which are working well. I think just to mention on your point about green and brown investments, I think the industry feels overall that we generally do not support a special green factor or a brown factor for investments. We don't yet have any strong evidence of that there is a really difference in the risk basis, and we really want Solvency II focused on the risk approach. However, what we would point out, and I think that's a very important point, is that those green investments, the sustainable investments, they tend to be long-term, they can often be illiquid, and those are exactly the type of investments that are treated not appropriately under Solvency II. So if we get the right treatment and improvements, that will also help our ability to invest in green investments, sustainable investments, and combined with all the work the Commission is doing on disclosure, that will naturally help and encourage insurers to invest sustainably and green.
Let's stay with you for a moment, if we can, Olav, and let's talk about what some of the barriers to long-term investment need to be addressed. And before that, actually, thank you, as always, for correcting me, which is something you've been doing for a long time in both of our times in Brussels. So thanks for that. So barriers to long-term investment, what should we be looking at in the Solvency II review?
Well, there are two areas where there are barriers. One is in the way the balance sheet is measured, and the other one is in the way that the capital requirements are measured. And in terms of the balance sheet, this is really about how we measure liabilities and the volatility of the framework. Insurers have a particular business model. We're able and willing to invest long-term because of our long-term liabilities. We pool our risks and we manage liabilities together with assets. And this needs to be captured within the regulatory solvency framework, but also, by the way, in the accounting regime. And at the moment, the Solvency II does not mitigate the artificial volatility correctly and also exaggerates the value of the liabilities. And there are two elements in particular where improvements are needed to address this. One is in the volatility adjustment. This was one of the measures introduced to try to recognize these features of the insurance business. And without it, Solvency II wouldn't have worked at all. So it works to a certain degree, but really doesn't work well enough. and some improvements are needed so that it better reflects the way in which we invest and also mitigates volatility. There is another element of volatility management, which is called the matching adjustment. This works much better, but it also needs some refinements. But there is a large agreement on those refinements, and there's agreement between the industry and the EIOPA recommendations in terms of that. So we're pretty confident those issues will be addressed. The other element of the balance sheet that really needs looking at is the risk margin. This is something which is added to the value of liabilities, the amount of assets we need to hold to meet all our claims and other costs as they fall due. And it adds up to nearly 190 billion across the industry. And this reduces our risk-taking capacity significantly. And there's a number of good reasons why it can be reduced. And so a significant reduction to the risk margin is needed.
Before we get on to a fourth thing, I want to just give a chance for Mr. Garicano to respond to what we're hearing so far. So do you agree with what Olav is saying about the matching adjustment? I understand that industry and EIOPA, the regulator, might agree, but obviously it will probably end up coming down to your vote. So what do you think about that, and also the volatility adjustment and the risk margin?
Yes, thank you. Yes, sorry about the trouble with my camera that was giving us a little bit of trouble before. I hope that's now solved. So I took note: volatility, matching, and even risk margin. So let's see. But let me just talk first about the broader question that you were asking, which is the barriers to long-term investments, and then we go to the matching adjustment. I mean, I agree. We agree with the industry that insurance plays a key role in promoting long-term investment. That is the point. I mean, all these long-term liabilities need long-term investments, but the key issue that is now strange and that makes things really complicated with long-term investments is that with long-term assets and liabilities, long-term interest rates are a concern. And when we move towards a zero-rate environment, like we've been moving for a while, maybe no longer, interest rates, a little change in interest rate changes dramatically asset prices and also makes the matching of liabilities and assets really complicated. I mean, I cannot imagine being now a risk manager at the insurance industry and wondering how am I going to pay with this zero rate my premiums on long-term life products and things like that. Now, having said that, then for that reason, the main priority for me and for Renew Europe is to make sure that the insurance sector is resilient to all these changes, particularly interest rates. So we support EIOPA's on the yield curve extrapolation, and we do think that Solvency II must reflect the situation that we are going through, and particularly a negative interest rate environment. To be honest, was probably not in anybody's. I would wonder what the industry says about that, but it was probably not in anybody's radar when this started. Now, having done that, then of course promoting long-term investment is key, and I agree that, for example, equity holdings, there's only 3% of all the assets on the balance sheet of the companies are equity. That seems really, really very low. The Commission has already been moving towards increasing equity holdings. I think that we should help the Commission to move in that direction. I would support that, and we should be also thinking about sovereign holdings. In particular, the insurers have a lot of government bonds. I'm not sure if governments are as risk-free today as we make them to be, and we should help insurers go into their real economy. Now, three questions that were raised, and you raised at least one: volatility adjustment, the matching adjustment, the risk margin. I can just start with one or two, or we can just jump whatever way you want. But on the volatility adjustment, it's logical that the insurance can apply a volatility adjustment to reduce the requirement on the publicly traded debt, and that it's clear that the adjustment brings overshooting and undershooting. So that's quite clear, because it doesn't necessarily reflect the liquidity of liability. It doesn't. It might have cliff edge effects, particularly country debt was well known. So some tweaks to volatility adjustment to avoid these cliff edges by moving from European to national portfolios, etc., is welcome. On the matching adjustment, I support also what was said. I mean, the matching adjustment does allow for a matching of the long-term liabilities with long-term assets. That's a good thing. It's crucial in order to make sure that what we're trying to do is to encourage insurers to make the long-term investment is done. So very clear support, and also support for what you, as was your question, what the AUPA and the insurers are both pointing. I think Parliament will be also happy to move in that direction. And if you want, we move to the risk margin, or we stop here and let the discussion as you prefer.
Well, we can do that, but just a very quick. I'll have a quick reaction to the reaction, and then we come back to you, Mr. Garicano.
Yeah. No, I very much support the points made about the need for greater investment in equity, and that's the other part that needs to be addressed is the capital charges for equity, but also for debt and property. All of them need to reflect the long-term risks that insurers face, not the sort of short-term market volatility that tends to be the current focus of Solvency II. In terms of interest rates, we agree that negative interest rates need to be accounted for, and the current regime doesn't really allow for that within the capital charge. However, that's quite a different issue from the extrapolation. The negative rates are already fully incorporated into the risk-free rates that form the basis for the valuation of liabilities. And really there, in terms of the extrapolation, I think we would have a different view that there is no need to change the extrapolation approach, because the current rates are already extremely low, reflect the negative interest rates already. And if rates really do stay low, there are mechanisms, something referred to as the ultimate forward rate is a mechanism which will change and lower every single year, meaning the risk-free rates will lower as well. So we think that there's enough safety mechanisms within that to avoid the need for any change in the extrapolation.
Okay, noted about that. Good, Mr. Garicano, you had a few other questions waiting for you while you're.
No, on the extrapolation, just very briefly.
Yes, please.
So basically, what happens now is that we take a 20-year maturity, and then onwards we move forwards with it. The truth is that the yield curve doesn't need to be extrapolated, because we have much better market data. So we have, for example, examples with Austrian long-term issuances, which have lower yields than the extrapolated yields. So this could lead to under-reserving and wrong risk management. I mean, I realize that, and the industry is right, that if we go the way AUPA proposes and we take into account market rates, we might introduce some volatility, and we need to be careful. But I do think that we need to take maybe more note of those market risks. And I'm happy to hear more disagreements. So we are all trying to learn about this, of course.
Well, Olaf, you've gotten, at least some of your points, seem to be taken on board, but some counterpoints. What do you say to that?
Well, I think that the main area of disagreement does seem to be around the extrapolation, and I think that obviously the discussion can get very technical quickly. But I do think that the rates currently, there is an extrapolation method. It's designed to allow for stability. I mean, if long-term rates were very high, I think then we would hear the opposite argument, that we should be careful of taking in sort of long-term spikes in interest rates, because that can change quickly. So I think rates are indeed very low right now, but no one really knows where they'll be in 5 or 10 or 15 years' time, when companies have to reinvest, and then the curves will become a sort of reality. I think for the moment, the extrapolation method, we think, provides a very conservative and safe approach in terms of reserving, and therefore is fit for purpose as it is.
Great. I have to say, we could keep going and going on Solvency II. I guess, since we want to cover a few other topics, maybe I'll come in with one last question specifically on the Solvency II review, and not really getting any further into the technicalities, but I just want to say, emotionally, are you ready to start talking about Solvency III? Whoever wants to.
So I mean, I wanted to to try slightly, I know you don't want us to get too technical, but just because I don't think this is as technical as it sounds. So we have long-term liabilities and we have to match them, right? And the question is, how much are assets going to yield in the longer term? What are the long-term interest rates we should be computing in our models? Because the valuation depends crucially on that. And I think to the question, yes, if the interest rates in the market were high, then we would want to be more prudent. I think yes. I mean, I think, but both are towards being more prudent. When they are low, we have to be careful, and when they're high, we have to be careful. And I would say the environment now, I don't know. I mean, we want to be careful, right? But the environment now of very low rates has been persisting already. If we see the long-term interest rates over the last 4 decades, we are 4 decades in a row where the rates are going down every year and every decade. So and that's why I think that maybe we have to take into account more market information. And I agree with the point all of the industry is making, that is, look, I mean, that's going to introduce volatility. If rates go up, rates go down. So we have to take care of the volatility. But I am sympathetic to the idea that we have to be a bit more conservative. As to thinking about Solvency III, I think the regime is the system is not broken, and I don't think we necessarily need to rush into something after this June review.
Olav, do you want to
I would very
address
much
that
agree
last
with
part?
that. Very much agree with that. I think as I think everyone agrees, the Solvency II is working overall pretty well. It's a very cleverly designed system. It's very comprehensive. It covers 28 different risks in the standard formula, even more potentially in the internal models. So I think the basic framework is good. We just need to make some focused improvements in order for it to reach its full potential and remove the barriers for investment. And as I said, there's something I don't think we have time to talk about, but I think improving the proportionality and is really a key issue as well. There
we go. We'll call it Solvency 2.2 for now. So I wanted to just get into a few other topics. And by the way, for the audience, please do go on Swapcard, send us your questions. We can certainly come back to Solvency II in the review, so don't feel like that topic is closed off to you. So waiting for your questions. But while I still have you for another 10 minutes or so, maybe we could talk a bit about crisis management, supervision, and systemic risk management. Let's see, maybe Olav, you could sort of kick off the section. Tell us, what do you think needs to be done in terms of managing systemic risk? Well, I think, first of all, it shouldn't be forgotten that Solvency II, because it's so complete, it already covers a number of elements to do with systemic risk, and that has been recommended as part of some global standards in terms of what they refer to as the holistic framework. So, for example, regular stress testing is something that is already part of our framework. It's done by EIOPA every few years, and companies already include stress testing as part of their ongoing internal risk management. I think where there could be some gaps, and I think it's when we say gaps, because we shouldn't forget that insurers are not generally systemic. If they undertake banking type activities, there is a small, obviously there is a risk there, but generally that has receded or gone since the crisis. So I think really we're talking about very limited extra requirements, and I think the type of requirements that the industry thinks is reasonable to discuss is things about liquidity reporting. Insurers already manage liquidity very well. They have, again, less exposure to liquidity issues than for example, banks, but it is, of course, something they monitor very carefully. But I think something to help demonstrate that liquidity is fully under control so that it's no longer a concern for the supervisors is potentially worth discussing. I think the other areas is that's been proposed internationally and was part of the consultation from the Commission was on advanced recovery planning. Again, Solvency II already requires recovery planning as soon as the SCR is breached, and it shouldn't be forgotten that the SCR itself is an early intervention point, significantly in advance of the real minimum, which is the MCR. So we already have an early intervention point, and that should stay. But I think in certain cases where you have companies that could affect the systemic situation at a European level, I think advanced recovery planning is something that can have some value and could be discussed. Mr. Garicano, what do you think?
Well, just to start on recovery and resolution planning, I think that the system does lack legal certainty. I mean, the industry doesn't like very much to have powers before requirements are breached. But the truth of the matter is that right now the only measure that's available to the supervisor is once the insurer falls. So the kind of resolution tools that we have seen in banking, I mean, here come a little bit late. So I think that developing resolution plans like the SRP requires of banks is a good idea. I think those living will kind of things help. I think designing a resolution authority at the member states would be a good idea. And that the resolution authority, like it happens for banks, should be able to intervene before the minimum capital requirements are breached, because that is a bit too late. And I know this is a bit controversial with the industry. Now, the key thing for me, though, and John, you know, we are dealing with this with deposit insurance all the time for banks. The key thing for me, as a member of Renew, of a pro-European party here, is that all policyholders should be equally protected throughout the union. We should aspire to a single market, true single market. And like in banking, you cannot have a single market if a euro of insurance is worth less in one country than in another. And this is particularly, the Commission says we should start with life products, with insurance guarantee schemes for life products. Well, that's fine. We can start with harmonized rules. It's the same debate we're having with deposits. It's a pretty complex debate, and it has complex implementations. We could have the home country is going to pay everything from the home country pays the policyholders of the host country to a completely EU harmonized system. There are like multiple options, but for me, regardless of the option we choose, I think that we need to aspire to a euro of insurance being worth the same everywhere. A true single market requires that.
We need to ask Olav what you think about the idea of insurance guarantee scheme regime, but also don't forget we'd like to, reaction to what you just heard on, intervention powers.
Yeah, I think on the intervention powers, I think, as I mentioned, and I really don't think this is maybe well enough sort of recognized or discussed, is that Solvency II has two levels of intervention. They have a minimum capital requirement, which adds up to, across Europe, about 210 billion in euros, so a very significant amount of capital. And I remember, even if that is breached, we still have the risk margin, which is yet another buffer, as I mentioned. But before the MCR is breached, we have the SCR. Now, the SCR is about 610 billion across Europe. So, in fact, we do have a very early intervention point, very significantly earlier than when the company is really breached its absolute minimum, which is the MCR. So this was one of the innovations about Solvency II, designing this two-level system with the SCR and MCR. And of course, companies choose to hold buffers above the SCR. And in fact, because the system is so volatile, they currently have to hold very large buffers. Some of them hold even up to 100% buffers. So, and all of this is monitored, of course, by the supervisors on at least a quarterly basis. So we do feel that there is already an early intervention point, and that gives exactly the control that is needed and was mentioned. So I think on early intervention, we don't really need it. But as I said, advanced recovery planning so that the company is prepared, advanced resolution planning so the supervisors are prepared. I think all of that makes sense. I think one other power that we have supported is the power to stop mass lapses. This is a very rare occurrence, but if it did happen, there is in certain cases, a very limited risk. But if it did happen, having those powers makes sense. And we see that, in fact, in countries where it can be a risk because of the nature of the products, often the supervisors already have that power. So making that a general power across Europe is something that could make sense as part of this sort of macro picture.
And then on the insurance guarantee schemes, what's the industry view?
I think we don't see the value in doing that. I think also we would point out that this would create yet another buffer of capital. And if IGS schemes were planned to be part of the whole regime from the beginning, I think we would have designed probably a different regime with a different target capital. And we see in countries and markets across the world where the IGSs are an integrated part of the solvency system and mandatory, they tend to have a higher tolerance for insurance failures and lower capital requirements as a result. So I think it would have been designed differently from the beginning. I think that there are a lot of complexities in trying to achieve harmonization. I mean, I think you have the problem of sort of moral hazard. Now, that may not be avoidable in the banking system where there is a basic vulnerability in terms of a run, and we need an IGS for stability and confidence. I don't think we face the same situation in insurance. And I think we can achieve the €1 equals €1 by having Solvency II applied in the correct way across Europe as it was intended.
Great, thanks for that. We're running very short on time. I still have to get back to the poll. So I promised we'd address supervision. So maybe yes or we'll do this as a yes or no question. First, for you, Mr. Garicano, how to phrase this as yes or no? Central supervision.
More than now, yes.
Excellent. Olaf, central supervision, yes or no?
No.
Good. We could
you
go.
Wanted that. You wanted that last.
Well, I'm only sorry we don't have more time to tease it out. So, you both addressed, I think, the idea of green incentives. In fact, both of you, one of our, I think, key takeaways from here, both of you agree, probably not a case yet for green incentives. Looking at the results of the poll, excuse me as I'm looking off screen here, it appears that the audience is with you, so obviously this is a consensus. Our top responses to the poll were in favor of brown penalties and a mix of green and brown. But a quarter of the respondents actually said, go for neither. It's all about risk management. So there you go. I guess for other takeaways from this session, I wanted to note that there's a lot of agreement on the need for having more capacity within the rules for long-term investment, especially equity investment. No great controversy there, but certainly some discussion to be had around how to get that done, and also what to do about low interest rates. I have the feeling this is going to be a long-running fight in the review of Solvency II. Thanks to both of our panelists, Olaf Jones, Luis Garicano, for covering all these issues for us. We really appreciated having you.
Thank you. My pleasure.
And to you for the audience, thanks for staying with us, but don't go away. Coming up, we have a presentation from Principal Analyst David Morris from Insider Intelligence to talk about digital payment trends for the year ahead. That's going to set us up for our panel to follow, which is on also on digital payments to be moderated by one of my very able colleagues in just a few minutes. So don't go away. Thank you.